there. So this is a first. I'm going to give a video brief on what happened today in the market and try to give you in about 4 or 5 minutes a rundown on things that we'd be talking about if we were in a meeting today. It was pretty eventful. You may have heard the Fed Chair, Jerome Powell, released the Fed's interest rate decision. They hiked rates as expected. I don't think that's what President Trump was looking for. Some people in the market weren't either. So we saw a fairly sharp sell-off in stocks on that news. The S&P finished down about 1.5%. And that's been, unfortunately, par for the course in Q4 of 2018. It's been a very difficult quarter in terms of volatility. So I want to just give a little bit of perspective on what I think is going on out there and how we're navigating it from a strategy standpoint. So to begin, what I'm going to do here is share my screen. And we'll start with a chart over here. This is the S&P 500 going back to 2017. And what you can see is the big drawdown here. This has all happened since September. That's when the market peaked. We were actually having a pretty good year up till that point. And we started off in January pretty strong as well before this correction, which after today has the S&P 500 down about 15%. The median stock in the index, I believe, is down over 20% now. The Russell 2000 index, small caps are down over 20%. So we're kind of teetering into a bear market type scenario in terms of the volatility and the extent of it. One of the things in terms of just kind of framing my view of what's going on out there, I think this slide paints a little bit more perspective on the volatility this year in terms of what's normal historically. 1950 through 2018, you can see what we're seeing in so far this year isn't really all that abnormal in terms of drawdown. If you go back over all the different years shown here, it's not nearly as severe as some of these rough years where there's really big corrections. I'm sure many people remember 2008, 2002, things like that. But this is kind of normal correction territory so far. Why it's felt, I think, a little bit worse than that, at least from the people I've dealt with, I think there's a feeling that the market's really had a tough year this year. And part of the reason is there's been 2 corrections of at least 10%. We had that one in January 1st, and it's very rare. I think it's since 1990 or so, since we've had 2 double-digit drawdowns in 1 calendar year. So that's why it feels like it does for a lot of people out there. And you see that reflected in sentiment surveys. This is one that I watched, the AAII investor survey, and you can see down here, this was actually last week. I'm expecting when this is released this week, probably tomorrow, the number might be even lower. But we clocked in at 20% of the respondents to this long-running survey saying they're bullish. You can see historically that's kind of a trough area in terms of how bearish sentiment tends to get find a bottom. And when you track this index over time, really what happens in the middle isn't too consequential from a signaling perspective. But when you go over 50, I pay attention. That's a sign of complacency to me, usually, that investors are too enthusiastic maybe. And we saw that earlier in January this year when we made that big high. But now we're way down here where we were at the bottom of the market in 2016 and a few other points over the last 10 years. So this is, I think, an encouraging signal that maybe we're kind of getting closer to the end than the beginning of this constant selling pressure that we've seen. The only thing that tends to reverse the sentiment is when the market rebounds, then people feel better, of course. A couple other statistics, just for perspective. US stocks have averaged 34% returns in the 12 months after a 10 to 20% correction. That's well above average. And we're right in the middle of that 10 to 20% range right now. Also, in years when you get minus 5%, plus 5%, that kind of down a little, up fairly type of outcome, that leads to above average returns of 24% since 1926, looking out over the next calendar year. Those aren't promises or guarantees that 2019 looks rosy, but I think what we've seen in terms of the difficult year this year sets us up more favorably going forward, hopefully. Stocks have become a lot cheaper this year because the earnings have gone up a lot, but the stock market's slightly negative year to date, at least as of today, and that's got the PE ratio down under 15 for the S&P. First time we've been there since 2014. Unlike most things, when stocks become cheaper, people don't like them as much. It's usually not the way it works. But I think in terms of risk reward, a cheaper valuation is a safer place to invest. If you've attended meetings with me over the last year or so, maybe the last 6 months, I've been showing this chart quite a bit. It starts with, if you don't know where you're going, any road will get you there. And what I show is the SP 500 cycles in terms of volatility and returns. And we've been in this wonderful period since 2009 of above average returns with below average volatility. I've expected that to mean revert. I think that's kind of a reasonable expectation over the next 3 to 5 years, that you're going to see probably a period of lower returns, higher volatility. That's something to kind of just be aware of and preparing for in terms of expectations. But then also, there's kind of like this seasonal effect as to when does that actually start to happen. This picture here is a family in the snow, obviously in winter time. They're outside though, and they're having a good time. Winter conditions are tough if you're not prepared for them, and it's no different in the market. And this is where I'll transition to what I think is really going on big picture. Why the market has sold off today, why we've had a difficult quarter. It's not so much what the Fed's doing. That's, I think, a variable, but it's really the change in seasons and where the economy is going and how the market's interpreting that I think has caused the selling pressure recently. What I mean by that is in terms of the growth and inflation outlook. Where we are today is, I'll grab my pointer here again. We're in this quad 4 area. And what that means is if you divide the economic seasons into kind of 4 calendar seasons, like we have normally with the weather, there's a period of winter, which I would define as when growth and inflation are both cooling or slowing down on a rate of change basis. And if you look at all of the economic variables and track them in real time and forecast what that means for the trajectory over the next quarter or two, which a firm called Hedgeye Research that I subscribe to does the best job of, in my opinion, on Wall Street. And they've been forecasting for a while now a move to this quad 4, growth and inflation slowing. And that's the forecast for this quarter. It explains a lot of what's happening in terms of this risk-off sentiment in the market. And it's probably going to continue into first quarter of 2019 based on the current data. So what does that mean? Well, when you're going into winter season, somebody from Chicago like myself, they have a wardrobe that spans, summer clothes, winter clothes, and then there's those in between spring and fall clothes. And the thing you want to wear in terms of your portfolio in a quad 4 scenario is you want to be generally underweight riskier assets. They tend to underperform in this type of environment. You want to be cushioning your portfolio with some defensive sectors like healthcare, staples, real estate investment trusts, and utilities. These are the biggest overweights in our portfolios. They've been that way since September. And that's helped quite a bit in terms of this recent sell-off and protecting our drawdowns, doing quite a bit better than the market. The things that don't do well, thankfully, we're underweight because this has been the macro forecast. Technology, energy, and industrials are some of the areas that don't do so well when growth is slowing. So that's kind of our way of looking at the macro analysis from a strategy standpoint and positioning. But a big part of what I do also, it revolves around the security analysis, or the bottom-up part of this funnel here. And that really involves just trying to pick good companies that have conservative balance sheets and have high profitability. Those are kind of the defining characteristics that I really look for when I'm picking individual stocks for the portfolio. And I follow that mentality throughout the cycle. It's just kind of what I believe in. You always want to be prepared for, an adverse climate. I've certainly seen a few of those in my career. So the portfolio is basically a high quality portfolio, and what that historically has correlated to in terms of backtest performance. We like to fish in this first pond of quintile 1, which is the stocks that score best on that criteria. They have above average returns compared to the rest of the market, but they also have, the axis down here is volatility, below average volatility. And so that helps in an environment like we're facing right now. I'm not sure where the bottom is. I think we're getting to a point now where stocks are pretty attractive. The best I've seen in terms of pricing in 18 months at least, I'd say. If this is going to go down in the history books as a bear market that we're in right now, we'll probably see things linger into the new year. But one thing that gives me a little bit of confidence, at least in terms of the scope of how deep this could get, I don't see a deep bear market. I don't see a repeat of 2008 in the cards, or even something like the tech bubble the current cycle has been compared to. Valuations I showed you earlier, they're not that extended like we were in the late 90s. So the tech bubble, type of affair doesn't seem a good comparison. And where the economy is, in terms of its expansion, I think is a reason investors should feel better about the next downturn not being as severe as what they've gotten accustomed to in this current millennium. And the reason for that is, even though we've had a long economic expansion, this blue line is the current cycle compared to a bunch of different cycles, which are the different colors in JP Morgan's chart here. Even though it's been really long, it hasn't been very strong in terms of the economic recovery. You can see it's lagged these other cycles by quite a bit in terms of how much the economy has grown since 2009. And the silver lining with that is it probably sets up a situation where we don't have as much overexpansion in the economy as we've had in previous cycles, which hopefully, and I think should probably lead to less severe recession risk in this cycle. And that's usually what really causes the severe pullbacks in equities when the economy is tumbling into a deep recession. But it's unlikely given the type of expansion we've had. So that's it. That's my update. I'd encourage viewers to enjoy your holidays. It seems like the Grinch has come to Wall Street this year. That's no fun. But I do believe we're going to see this selling pressure start to alleviate soon. And we'll keep an eye on that for you. Thank you.